All right, thanks for joining us again. We've got some more news on how the CARES Act and the forbearance as it applies to mortgages, how that's being worked out with the regulators. So we're going to look at the new protective measures that have been put in place for consumers. Let's get started. So as you know, the CARES Act, Section 4022, allowed consumers to request loan forbearance on their mortgage if they had a federally backed loan. This was for Fannie Mae, Freddie Mac, VA, FHA loans. And the timing was a little bit different on them. If you had a property with 1 to 4 units, you could request that forbearance up to about 360 days. If your property had more than 5 units, however, you only got about 90 days. And there were some different rules that applied to that. But one of the problems that people were running into, and we actually were getting a decent amount of comments, emails, text messages saying, hey, Josh, this is all great that there's this forbearance out there, but when we're talking to our loan servicer, they're like, yeah, fine, you can forbear, right? Now, don't pay your loan mortgage for 6 months or 12 months or whatever the time frame is, but then at the end of that 12 months, you owe the entire amount that you didn't pay on that day. Well, you can imagine if someone can't pay for 12 months because they have the financial difficulty of the COVID-19 problem, you can imagine they don't have the cash to come up with 12 payments at the end of that time period. And so the forbearance has almost felt like a trick in many ways. Well, let me show you what's come out just recently. So this is a document put out by some pretty big agencies. So first of all, this is the people who are on this document. Board of Governors of the Federal Reserve System, the Federal Deposit Insurance Corporation, that's the FDIC. You've got the Consumer Financial Protection Bureau. So there's some really big hitters here. And this is guidance to the loan servicers, to the banks who gave out the loans that are being backed by the federal government. And this you can see is April 7th, so it's fairly recent, like we're April 10th right now. And just as we go through this document, I'm going to highlight different portions of it. We'll link it into this video so you can read it yourself. But I want to just draw some attention to some of the things it's saying. So we know that the CARES Act was signed into law, and the CARES Act creates a forbearance program for federally backed mortgage loans. It protects borrowers from negative credit reporting due to loan accommodations related to the national emergency. So it's just setting it up. This is what we're trying to do. We're trying to protect borrowers from negative reporting due to the loan accommodations. Goes on to say that the agencies, that's these guys up here, these 5, encourage financial institutions, that's the banks, to consider prudent arrangements that can ease cash flow pressures on affected borrowers, improve their capacity to service debt, increase the potential for financially stressed residential borrowers to keep their homes, and facilitate the financial institution's ability to collect on its loans. So you can kind of see there's key points that what these agencies are trying to accomplish with the forbearance piece of the CARES Act. So one, cash flow, right? Service the debt, keep people in their homes, and collect on the loan. So let's try to figure out how we make that happen. How do we work together to make that happen? Further on in this document, this is pretty deep down, but there's a couple points here. The agencies will take into account an institution's good faith efforts demonstrably designed to support consumers and comply with consumer protection laws. The next one, the agencies do not expect to take a consumer compliance public enforcement action against an institution, provided that the circumstances were related to the national emergency, that's COVID-19, and that the institution made good faith efforts to support borrowers and comply with the consumer protection requirements, as well as respond to any needed corrective action. So they're kind of saying, hey, we're gonna cover you. Just go help borrowers, keep people in their home, improve their cash flow, and figure out how to get these loans paid down the road, and we'll take care of the rest. This next document is actually, there's an FDIC document, and it has frequently asked questions for financial institutions protected by or affected by the coronavirus. So this first question, it's in the section called Working with Borrowers, Payment Accommodations. So the question is, would it be acceptable for a bank to offer borrowers affected by COVID-19 payment accommodations, such as allowing borrowers to defer or skip some payments or extend the payment due date? And here's what they say. Yes. The FDIC encourages financial institutions to provide borrowers with payment accommodations. There's a lot of words in here, so I'm going to try to get to the meat and potatoes here. Next, financial institutions may want to consider addressing any deferred or skipped payments. This is the big one, by either extending the original maturity date or by making payments due in a balloon payment at the maturity date of the loan. So there's two things there, right? They're saying, here, consider this, do this, extend the maturity date or build out a balloon payment. Okay, so let's look at both of those here in turn and what that kind of looks like. So this first option, they say, consider doing this, Mr. Bank. Let's say, for example, that your loan matures in March of 2040, so it's 20 years from now. You get 6 months of forbearance during the national emergency, and then that would mean that your new loan maturity date would be September of 2040, right? You would add 6 months to March, add 6 months to it, and so instead of being March that your loan is paid off, it would now be September, 6 months later, right? And that's kind of what we talked about in our first video, that probably they would push pause, push it out 6 to 12 months, and hit the play button. That's essentially what we're doing. Everything kind of just gets kicked down the road 6 to 12 months. The second option, though, is if the mortgage, say, this is an example, if your mortgage payment was $1,000, and keep in mind that this would not include your taxes and insurance. If you're getting escrowed, that's still going to have to be paid most likely. But if your mortgage payment, principal and interest, is $1,000, if you had 6 months of forbearance, you'd owe $6,000, right, that you didn't pay during those 6 months. And you'd owe that, and I'm sorry, that's a mistake, actually. I'm just going to go change that here a minute. You would owe that $6,000 in March of 2040. That'd be that balloon payment. However, you would have a ton of equity built into your home by that point, right? And so that you could easily finance that last $6,000 and just get a short little loan for another 6 months. So either way, it kind of ends up being back to option one. So at the end of the day, that's what the FDIC is saying. Let's look at that one more time. So read it again. So address the deferred or skipped payments by either extending the original maturity date or by making those payments due in a balloon payment at the maturity date of the loan. Direct guidance from the FDIC. There's one other piece in this FAQ document I wanted to call your attention to, and that's the second question. So reporting delinquent loans. So the question is, do loans that receive payment accommodations have to be reported as delinquent or non-performing? And it says this: borrowers who were current prior to the emergency generally would not be reported as past due. Okay, so what they're trying to do is they're trying to say, hey, listen, this whole thing had nothing to do with a borrower's willingness, ability to pay. When we shut the economy down, we don't have a prayer, right? We just do not have the ability to do business, to bring in money to service our debts. And they're saying the borrower shouldn't be held responsible as if they're bad borrowers. Accordingly, if all payments are current in accordance with the revised term of the loans would not be reported as past due. So it shouldn't affect your credit, and it shouldn't negatively reflect upon you as a borrower. So what can you do? Well, some simple things. Just read the guidelines from the Fed. I know it's boring. I know it's dense. But just the fact that you have read the document what the Fed has told the banks to do gives you power, right? Share that guidance with your loan servicer. It was probably only 3 days ago, maybe 4. It was certainly this week that we had a conversation with a loan servicer, and he didn't even realize the CARES Act 4020, that there was forbearance. And once we told him about forbearance, he's like, oh my word, that's horrible. What's going to happen to the banks? And how are the banks going to pay their bondholders? And this whole thing's going to roll downhill. And we're like, yeah, we know. But they don't even know yet, right? And they're going to know, right, real soon. But if you're that far ahead of the ball game that you're getting in front of a servicer that really doesn't know what's going on, share it with them. And then make sure that you negotiate something that works for you, right? If your servicer is not giving you the things that you know the Fed wants them to, don't settle for a bad deal. Keep working it. Call them back. Find someone else who can help you with this. But don't agree, and again, do what you want, and definitely talk to your own attorney. But if it was me, I would not be agreeing to making those 12 payments all up at the end of the forbearance period, because that could really sink you. All right, so that's what I've got for you. Hopefully that helps. Hopefully you can find your way through the weeds on this. And of course, if you ever have questions or need guidance, we're here to help. Get in touch with us, support@expressrpm.com, or our phone number and our website should be on there as well, but it's expressrpm.com as well. Thank you much.